Hey everybody, this is Brant from Wolf on Wall Street Trade, and woof, gosh, I would have loved to have done a live stream yesterday. This was a great week for it. But quite honestly, if you look at the live stream video from last weekend and the repost as a video, there's so much really good stuff in there that happened this week that we were looking for. So what I did was when I reposted the video, as other than a live stream, but a video. In the description, I put little time markers and they're in blue. Those are links and they tell you what that specific part of the video is about. So what happens right before a recession with the yield curve, and then it'll have that little blue number that links. So you just click on that, it'll take you right to that spot of the video. So you don't have to watch the whole thing, but there's some fantastic stuff in there. Great concepts, stuff that happened this prior week that we were expecting. And I think it's really worth a look if you have the chance. As far as the live stream this weekend, my gosh, if you're a subscriber, a member, you know for the last 2 weeks I've been doing probably 12, 14, 16-hour days. My daily wraps have been like comprehensive. It's just exhausted. I needed like a mental health day, but I did want to be here for you as we go into the FOMC this Wednesday, which is really the big deal of this week. Now, let me get my glasses on, my trusty glasses, and just want to go over a few things for you real quick. So I love what I do. I love the people I do it for. And what I see my role as is evening the playing field. Okay. So if you're not the elite, you're not on an even playing field. And I'm going to give you an example of this. So SVB, Silicon Valley Bank, right? In last weekend's video or the live post, I said, I can't remember the exact number, but maybe it was like 5 or 10% of SVB's deposits were insured with the FDIC. And above that, the majority of them weren't insured. So total loss, right? With this bank going down, unless you happen to be an elite. So SVB was known as a fund for venture capitalists, right? So I just want to read you a couple quick things about what Silicon Valley Bank did, what happened, and what's happened since then. So Silicon Valley Bank went from getting their debt rated A by Moody's just weeks before the bank failed, right? Prior to that bank failing, the executives were paying themselves bonuses, right? And they were selling their shares right before the bank failed and was taken over by the FDIC. 98% of their deposits in SVB were uninsured. So that means 2% were insured, 98% complete loss for those depositors, right? Unless you happen to be in a favored bank and an elite. Again, this was a bank that really catered to venture capitalists. Last weekend, on Sunday, the FDIC, the Fed, the Treasury decided that SVB deposits were going to be insured in total, above and beyond the FDIC limits. Okay, no losses for the depositors at SVB because, again, it is not a level playing field. So if your business, as a small business, goes bankrupt or has trouble, don't expect the government to bail you out. Don't expect a golden parachute like a lot of these CEOs have been getting. Don't expect that. You're not that side of the game. And that's what I try to do, is even that playing field. I am going to put a link in the video description, and I think it's really worth your time. It's about 4 minutes, and what that link is Representative James Lankford. This is not about politics, by the way. Okay, this is on both sides of the political spectrum, this elitist kind of view, and these guys get bailed out by both sides. So in any case, it's a quick video. Representative James Lankford, who is questioning the current Treasury Secretary Janet Yellen, who used to be the former Fed chair, right? The Fed independent bank and our independent central bank and all that, not political. Take a look at the video. You're going to be shocked by what you see. what you're going to see is crony capitalism at its finest. We don't get to see this that often because, like I touched on in last weekend's live stream in the video, is that the Fed rate hikes almost always break something. It looks like the Fed has broken something. So kind of the idea is when the Fed starts to panic, the market stops panicking. So the Fed, the FDIC, the Treasury did all this stuff. It wasn't quite good enough for the market. The market wants more. And that is going to get really interesting as we move into the FOMC this Wednesday. So let's take a look at some price charts. I want to just show you what I've been talking about for all of this year. If you've been following me, if you're a subscriber, you know which stocks I like and which stocks, I'm not so hot on. So here we go. This is TC2000. And what I want to do is just run through the price action of the averages. We don't need this trend line stuff. So let me pull up the SP 500 first, right? So we're just looking at, so this started as a bull flag, right? Could have been a potential bear trap, but failed, right? Here's the whole banking stuff failing. So we did get a big relief rally in the middle of the week, this prior week, and it left this little bear flag here. Now, the S&P did manage to invalidate that bear flag. Okay, so you see the little breakdown here and it invalidated it. Now, this trend line, as far as these two trend lines, which were the former large bull flag, I don't consider these to be a valid bull flag anymore, but as you can see, price is still respecting these two trend lines. So we come up to that on Thursday and back off. Friday was a massive quad witching options expiration. That's once a quarter. And the fact that the S&P just sat here and traded around 3,900 on Friday right there tells me that there was a heavy influence from that quad witching. So it looks like prices were just at the max pain pin. I think that is really what we're dealing with on Friday as far as the S&P 500 goes. Let me show you some of the other averages real quick. And this is going to be the Dow. So it had a similar bear flag coming into the week on this little relief rally. It looked like a really strong day on the relief rally, but it didn't change the price action at all. It left this bear flag. So the Dow tried to invalidate it, didn't do quite as convincing of a job as the S&P 500 did. So the Dow, in my opinion, is still not looking so fantastic. And this is what I expected towards late summer of last year when I said I think we're going to see a rotation. The Dow carried the first half of the rally. It gained 20%, right? From the October lows to the November highs. I said I think we're going to see a rotation to the mega caps and the Dow is going to underperform. So that is kind of what we're seeing. Let me show you IWM small caps because they are, of all the averages, they have so much exposure to these regional banks that are really getting pinched. The one good thing they did, so here's Monday's low. The one good thing they did is they tested that low around 171 for IWM, and they held it. 1, 2, 3, 4 retests of that low. They held it. So it's not a fantastic chart, but they held it. Now that we've seen all those, let's look at the NASDAQ 100. First, real quick, again, the SP 500, the Dow, that relief rally this week left them with a bear flag. Now let's look at the NASDAQ 100. That relief rally this week left it with a bull flag and sitting at the top of its large bull flag range. And this is the only average that still has this large bull flag intact, which also broke out this week. So if we look at the daily charts real quick of the averages, I'm going to pull up the SP 500 first. And we don't really need all these moving averages. What I really want to show you is just the candles on the week. So these are daily candles. S&P, right, had a really nice strong day Thursday, but really didn't make it over that 200-day moving average. There's not one instance here of 2 consecutive days of closing green. Same thing with the Dow. There's not one instance of 2 consecutive green closes. Same thing with small cap IWM. Nothing. We have that 171 level that was held, but we don't have even 2 consecutive green closes. Look at the NASDAQ 100. Bam, 1, 2, 3, 4 out of 5 days last week when the market was going through some exceptional volatility. 4 consecutive green closes. Big, huge candle on this breakout. on Thursday. So NASDAQ 100 still is the group or the average and the group of stocks of the mega caps that are outperforming. Next, I want to show you some 3C charts, okay? So we're going to look at 3C on Stock Finder. And here we go, Stock Finder. This is one of the most interesting things. So coming down, this is kind of the banks freaking out the whole market, right? So coming down over here, this is the SVB collapse. Look what 3C is doing. This is a huge, huge positive divergence. That is accumulation. Okay, so the power of 3C, it's a money flow indicator. The power of 3C is that it has the ability to contradict price, which is what it's doing here through this divergence. So it's showing accumulation, and it was leading the NASDAQ or the QQQ higher. And with all this price action this week, all that positive momentum in the mega caps, look what price did. Went from here with 3C leading higher to catching right up to price. This is kind of the essence of what 3C does when it's like really giving a great signal. So that is QQQ. I want to show you IWM real quick. So here, what we're seeing is kind of the price trend where, and remember, small caps have an exceptionally high exposure to the regional banks, the smaller regional banks. So we can see 3C here not confirming this little bounce in the SVB failure, but we do see this 171 area at least posting some kind of relative positive divergence. So that's basically, it's not screaming strong support, but it is showing investors or traders showing up here at this test of support around 171. Again, it's not screaming strong and jumping off the chart, but it is what it is. So we can see there is some reason for that support there at that level. So let's take a look at the SPY. And what I want to go back to is the longer term trend that kind of represents the 3C chart, that represents the rally off the October lows. And what we see is 3C leading higher up to the measured move target, which came out of the October base. That was 4150. So for the S&P, it hit that target right about here, and S&P actually went up to 4200. That was the measured move target. The next thing I expect when that is hit is a price consolidation. It started as a bull flag, and here you can see 3C's tone just weakens a lot right here. But as we've come down, we do still have this relative positive divergence. This is not what I would call tactical signal. The 1 minute charts are like more tactical. This is more of a trend signal saying, hey, this trend is still alive, this rally trend off the October lows. But as far as the short-term timing signals that are like tactical, like take action, not so fantastic in any of the averages except for, again, what we saw in QQQ. And then high yield credit, which is one of my favorites because it's kind of like a window into what institutional money's doing. We did have a relative positive divergence between HYG and the S&P right in here, and we can see it in 3C as well. So we have a higher low over here in 3C and starting to lead. So this is a positive thing. Again, it's not the best signal. It's not like the signal I would love to see from a bullish perspective, but it's constructive still. And now what I want to do is show you why, and you can see this in last weekend's live stream or the video replay, why I still favor these mega cap stocks and have been looking for those to rotate in since probably late summer of last year. And that's exactly what we saw coming into 2023. First, as I showed you, NASDAQ 100 has already broken out from this bull flag. Here's the bull flag in the middle of the week when every other average was posting a bear flag, right? And it was right at the top of this large bull flag. There's the breakout. So let's take a look at some of the sectors. Let's just look at the mega cap index. I use MGK. You can use whatever you want. I just would say be consistent about it. So I always compare MGK to the S&P equal weight index. So every time I reference that or the underperformance or the outperformance of one or the other, my subscribers know what I'm referencing. They know what it was last week. They know because I'm not changing the symbol all the time. You don't want to cherry pick anything. You want to just pick objective evidence, objective data, your setups, and you want to stick with them. So MGK, the mega cap index, what's it doing? haven't updated my trend lines yet, but what it's doing is breaking out just like the NASDAQ 100. If we go to some of the most important mega cap heavy sectors like technology, what is it doing? It's breaking out of a bull flag this week too, right? Awesome. Communication sector, you have Alphabet, Meta, or Facebook, whatever you want to call it, days, also breaking out here. So a lot of good stuff. The semiconductors, which tend to lead the tech sector, but they are going to be much more economically sensitive than the tech sector, which has a lot of big secular growth. But the Philly Stocks Index, breaking out of a bull flag. So if you look at just about anything else, there's nothing that looks nearly as bullish as these large cap, mega cap tech stocks and related sectors. Now, what I want to show you is what I would consider like a highly, highly speculative trade. But again, please, you have to participate in your own rescue. I am here as a resource. I mean, half the people that have been with me at Wolf on Wall Street Trade, which is going to be a new website soon, have been with me for years. And there are a handful of people that have been with me for, God, over a decade. I mean, since the start. What they all have in common is they're good traders, they're good investors, they take responsibility for themselves, and I share everything. I'm not trying to make anybody dependent on me and say, well, I have this trading service and I'm going to give you the stocks. No, I'm going to give you the information. I'm going to give you the concepts, and you can apply those because all of them are fractal in any way you choose. So if you're a day trader and I show you the measured move for a bull flag or a bear flag, right? That is going to be the same concept, whether you're a day trader and you're looking at a 1 minute chart, or whether you're a long-term investor and you're looking at a weekly chart or a daily chart. All the concepts that I share with you, I share with my subscribers. I'm not trying to hold out anything. I want you to know them. I want you to be able to apply them. So this is what I would call a highly, highly, highly speculative trade. This is not something that I would recommend if you're not really on top of risk management, and if you don't have the time to watch a really speculative trade. But going back to that video from last week, if you find the little clip about why I was so concerned about the banks and why the day before SVB failed, literally they weren't even on the radar. I was like pounding the table, telling my subscribers, look, this is serious. The yield curve has flattened so much in February and into March because of the hot data that it is going to drag the banks lower. It is going to be a major problem for the banks. The banks, if you look at that video, they caught down to like 5 weeks of intense yield curve flattening in 3 days. Okay, so the concept is that the banks are led by the yield curve. So I want to show you what happened recently. Okay, I'm going to take my mug off the camera here, and we're just going to look at Stock Finder. And what we're looking at is the regional bank index in the candlesticks here. And this is the 5-30 yield curve, okay, or yield spread in white. This is what I was talking about before SVP failed, all of the sharp flattening. So here they are leading. Here's the yield curve leading the banks off the December low, right? In this rally. Here's the yield curve diverging right where we would expect this consolidation, because the S&P hit that 4150 measured move. So consolidation, no problem. But then all of that hot data was bringing this yield curve down sharply, flattening sharply. And this affects the banks. It leads the banks. Why? Because what happens is when the yield curve flattens, banks borrow at short-term rates and they lend at long-term rates. But when this is happening, what's happening is when the curve is flattening, the cost of borrowing at short-term rates goes way up, and what they get in return for lending at long-term rates goes way down. So it's their net margin interest. It gets walloped. It gets killed. So that is why this yield curve tends to lead the banks. So here is what happened since the SVP collapse and since regional banks just caught down. I thought this might happen over 1-2 weeks, not a couple of days. So intense action. But what's happened since then, massive yield curve steepening. So KRE, the regional banks, don't look great from a price perspective. Like IWM or small caps, they did hold the week's low, right? But this price action doesn't look great. And this is why I say this is such a speculative trade. But again, the yield curve tends to lead the banks, and it has sharpened so steeply in less than a week. What happened over here took 5 weeks, a couple days over here to get all this sharp steepening. So in a normal environment, if people had confidence in the banks, this would be a major long signal for the banks. So I would say as a highly speculative trade, there is a reasonable chance that if there's some sort of risk sentiment that has improved about the banks and people feel better about it, even if it's just for a few days or a week, they have an opportunity to make this massive relief rally to catch up to this yield curve. But again, in the meantime, if we look at like the KBW Bank Index, it made a lower low. So in the meantime, it's almost like trying to catch a falling knife, and that's something I don't love. So when we look at the price action in the banks and we look at the price action in the mega cap heavy sectors, which one do you feel more comfortable with? For me, there's not even a question. But as a speculative trade, this could see the banks really move, and I have a suspicion that the catalyst for that potentially happening will be the meeting of the Federal Reserve, the FOMC, to set their rate policy. They start on Tuesday, and then the policy statement comes out this Wednesday at 2 p.m. And it's actually one of the few Fed meetings of the year that has the SEP, the summary of economic projections. That's the dot plot. That's what they think inflation is going to be at different various time intervals in the future, what they think growth is going to be. There's going to be a lot of information that we don't normally get in the FOMC that is going to be contained in this SEP. So if you even considering this as a trade, I would really, really, really make sure your risk management is spot on. Your position sizing reflects that it's a speculative trade. I mean, it's kind of like playing the lotto here. You're trying to catch a falling knife, but there is this huge signal of steepening. Now, this has a completely different macroeconomic meaning. In the short term, it could be good for the banks, but what it's telling us about the economy is not good. Okay, and now I'm going to show you some slides that I just captured and put together. This is going to give you a little bit more background on what's happening macroeconomically and what is at risk with the FOMC this week. So let me transition over to that slideshow. Now, the first thing that we're looking at is what I'm going to call the QE trade. If you're a subscriber of mine, you know that I have not liked Bitcoin at all. The price action has been horrible. I've said over and over and over again, I'm not even remotely interested in Bitcoin until it can trade above 26,000. This is 26,000. This is a bull flag, and this is a breakout above 26,000 up to 28,000. So all of a sudden, Bitcoin is getting interesting. Why? I think I covered this in the last video. I have mentioned it numerous times in other videos, and for my subscribers, you hear it all the time. Bitcoin is a speculative asset. When Bitcoin really flourishes is when there's a lot of money sloshing around in the system. When the Fed has rates at 0%, when the Fed is expanding their balance sheet through QE, which is mortgage-backed securities purchases and treasury purchases, but they can't purchase them in the primary market. They can't purchase them at auction. So the Treasury does an auction. If the Fed were to try to buy those treasuries at auction, that would be illegal. It would be monetizing the debt. So the primary dealer banks that pretty much run the Fed, because it's kind of a quasi, semi-public, semi-private institution, supposed to be independent. But again, as you can see with the bank bailout and what happened there, it's really set up for the elitists. But what I'm really trying to point out here is what is happening with these assets is they are starting to reflect the QE trade. Okay, quantitative easing. What the Fed has been doing is quantitative tightening. They've been reducing their balance sheet as they've been hiking rates. They are trying to tighten economic conditions, which is why Bitcoin acted so horribly for so long, and why all of a sudden when you see this kind of improvement in the price action, you're seeing traders and investors starting to think about and price in the possibility that the Fed may have just broken something and is about ready to pivot to either no rate hike, which would be a pause, which in effect really would be the end of the Fed's rate hike cycle. And I'm going to show you what's happened to the Fed's balance sheet recently. Okay, so let's go to the next chart. And what we're looking at here is gold, another QE trade. So if we look at gold, and this is a 15-minute chart, gold futures 3C, look at this positive divergence here in 3C. We see the breakout on price, volume increasing, some consolidation, volume comes down, another breakout price, volume increasing, and it's approaching 2,000. Now, it does have the exact same two fundamental correlations that have been driving it as stocks, which is an inverse correlation to the US dollar and an inverse correlation to US yields. So if the dollar and yields go higher, it's been hitting stocks, it's been hitting gold. If they go lower, stocks and gold have been benefiting. And in that video, I showed you also how gold has pretty much been leading stocks in terms of relative performance and market signals. It still is. And let's go to the next chart. This one is a 60-minute chart of gold. So here we can see gold with a negative divergence way back here in February, right? And we can see prices come down, right? And right into this level, I'm going to say that's around 1812 or so, we get kind of a little W bottom, a positive divergence, a relative positive divergence, and we can see gold taking off now, approaching that 2000 level. This is the QE trade. Why? This is the Federal Reserve's balance sheet. This gray area here is recession shading. Now, this is right from the St. Louis Fed's website, so you can get this yourself. This is all assets, total assets, less eliminations. So basically, the Fed balance sheet right about here, right before the COVID crisis, the COVID lockdown, that's the recession, the market crash in March, ended March of 2020, right? This is what happened to the balance sheet. It more than doubled over the next year. So when I pointed out in August of 2021, the very week, I pointed out that the S&P went from its COVID crash lows to a double, 100% gain in August of 2021. And I showed you the Fed balance sheet that had gone to, at the time, from 4.1 trillion to 8.2 trillion, the exact same week that the S&P doubled off of its COVID crash lows. The Fed's balance sheet had doubled. This is what I'm telling you. So when the Fed conducts quantitative easing and they buy from the primary dealer banks, Goldman Sachs, JP Morgan, all those, what those banks do is they take the money, that's basically free money from the Fed printed it out of thin air, and they put it into whatever is yielding higher, and it's usually going to be a risk asset, okay, stocks. When we're in the full-on QE trade, it's going to be the most risky assets or the most speculative stuff like Bitcoin, all right? So here is quantitative tightening. This is the Fed letting the balance sheet roll off as they've been hiking interest rates because they're trying to tighten financial conditions to kill inflation. They're actually trying, and this is a great thing to think about too. The Fed is actually trying to create a recession. The Fed is trying to increase the unemployment rate. The Fed is trying to kill workers' wages. Even though workers' wages, they are inflating, but they're not nearly keeping up with the inflation we've seen in the economy. The Fed is trying to punish the little guy to kill inflation. But they're not doing that for the elites. They're bailing them out. So this, what looks like a little bump in the balance sheet, is what has happened since the SVB, Silicon Valley Bank, failure. Here's a closer look at it. Quantitative tightening of the Fed's balance sheet. And over a week or so, this is what has happened. So in effect, even though the Fed has not pivoted, has not said, we're going to stop rolling off our balance sheet, we're going to stop doing that, we're going to provide more liquidity to the market. They haven't done that yet, but you can see it in the balance sheet. It's actually acting like QE, which is why you're seeing Bitcoin and you're seeing gold act much better. The market is contemplating and starting to price in the fact that the Fed went too far, broke the market. There's only one thing the Fed fears. Let's rank this in order. Okay, so the Fed typically has to deal with recessions. Usually it's 500 basis points of rate cuts in the Fed funds rate. They don't have that. They didn't have that at zero. So then what they have to do is buy assets to make up for that. The Fed is concerned about recessions, but not really as concerned as they are with inflation, which we haven't had to deal with in 40 years. Inflation is tough. It's tricky. My call in 2021, before the market even turned, the market was making all-time new highs, was this is exactly what was going to happen. The Fed was going to tighten conditions. They were going to hike rates, and they were going to shoot to raise unemployment, put the economy into recession to kill inflation. Now, the only thing that matters more than inflation to them is financial stability, which when we saw SVP or SVB, I don't know why I keep saying SVP, and some other banks like Credit Suisse, we see the Fed all of a sudden looking like they're going to get real dovish. Now, remember what I showed you with how much the yield curve has steepened with regard to the banks and everything over the last week or so. If you go back to last weekend's live stream video, I have a little section there. It's highlighted. You can click right on it and go right to that spot. You don't have to watch the whole video. I talk about what happens with the yield curve before a recession. So what I want to show you next is that. And I really strongly encourage you to go back and look at that video. So what we're looking at is the 2-year, 10-year, or the 2s and 10s yield curve or spread. And that's in blue. What you're seeing is recession shading in gray. And this line right here represents basically 0 for the yield curve. So when the yield curve inverts, it goes below this line. Now, the 2s, 10s yield curve has called basically every U.S. recession since World War II. Highly, highly accurate. But what I showed last week was this is the warning sign, this inversion in red, right? Here's the one right before the COVID crisis, COVID lockdown. And this was the deepest yield curve inversion since 1981. But the thing that tells you something imminent is about to happen as far as recession is when you have this inversion and then steep sharpening out of inversion. And then right there, recession. Again, happens over here, recession. That steep sharpening started to occur in the last week or so. Is that telling us possibly that we are that much closer to a recession? I think so. I've had my 3 phases of what I think we're going to go through with the market. First is the market rallies on peak inflation and peak Fed hawkishness. That's been happening since October, and it's still in effect. Phase 2 is the bill comes due and we have a recession. So if we look at some assets and how they're trading, here is WTI crude oil that has been in this range for about 3 months, and why I've had no interest in it. Here is WTI crude oil breaking down below that range. When I see 20, 30% drops in stuff like crude, copper, I see massive drops in some of the yields like the 10-year yield, even the 30-year yield. I see drops in commodity currencies like the Aussie. Those are all deflationary signals, and they usually come right before a market crash or a bear market. So this is not a good development as far as crude oil is going. And as far as the yield curve is going, what I just showed you, potentially it is about to steepen out of inversion. Now, 9 times out of 10, the reason we get this steepening is because the Fed sees something wrong with the economy and they have started to cut rates. That's their normal MO when we're coming up into or moving into a recession. In this case, it is the Fed transitioning from being hawkish to potentially pausing the whole rate hike cycle, potentially pausing QT, potentially expanding their balance sheet beyond what has already happened. And I want to show you one other chart I was talking about. This is the FRAOIS spread. It is kind of a measure of stress in the financial system. The gray shading again is recessions. This is the financial crisis. So you can see major stress in the financial system. This is the COVID lockdown. You can see major stress in the financial system. So basically, we saw a little bit of that in September, and the Fed got a little bit more dovish and financial conditions improved. The biggest spike since the COVID crisis. So this is saying the financial plumbing is at high risk. If we take a closer look, and one thing I want to tell you first is every time we've been at least this level, right, over here, the Fed has capitulated and stopped their rate hike cycle. They see the stress in the system. That is the only thing they fear more than inflation, is the financial system's plumbing breaking down, because at that point, it doesn't matter what their policy is if the financial system cannot allow that policy to filter out into the economy, right? If the plumbing is broken. Now, if we take a closer look, we can see that some of that stress has definitely come off, right? But usually once we're here, the Fed is done. So we've seen some of that stress come off. Why? And why has this balance sheet jumped like it has? Let me give you the stats real quick. As of last week, ending Wednesday, right, March 15th, banks borrowed a combined $164.8 billion from two Federal Reserve backstop facilities as of Wednesday. That is what this massive jump in their balance sheet is, right? The prior all-time high, almost 165 billion. The prior all-time high was back during the financial crisis over here, right? The prior all-time high was $111 billion in the financial crisis. So 165 billion in the last couple of weeks, way above what we saw during the financial crisis. So yes, there is absolutely a lot of risk in the banking sector. Data also showed another almost 12 billion that was taken from the Fed's new emergency backstop that they released last Sunday coming into this past week. I think it's called the Bank Term Funding Program. In any case, the point is we are going into the FOMC. Tuesday the meeting starts, Wednesday it comes out. And the Fed is in media blackout right now. So if they want to leak something, and they often do, they can't do it through a Fed speaker coming out. They have to leak it through the press. And what they usually do is they leak it through Nicky Leaks, Wall Street Journal's Timmy Reyes, I think his name is. They call him the Fed Whisperer. So if there's leaks, you look for his Twitter stream or Wall Street Journal articles he's written. That's where the Fed leaks. So what he said this week was whether or not the Fed goes 25 basis points. And remember, before SVB, we were looking at a lock on a 50 basis point hike. Now it's 25 or nothing. And what he said was the Fed's decision of whether or not they're going to go at 25 basis points or they are going to pause and not hike will be determined by the market's response in the next few days. So if the banks keep selling off and financial risk looks high, what the Fed is basically saying is that, hey, market, if you sell off Monday and Tuesday, it's pretty likely that we're not going to hike on Wednesday. So watch Monday and Tuesday. The market may say, hey, Fed, we've got a message for you. We didn't think what you did last Sunday was enough. We're going to keep selling these banks until you capitulate. So we may see that. At that point, I think we do still have an open window for the mega caps to rally, but I think we're going to be moving into stage 2, which is kind of the end of that rally and more into the recession. And then I think we'll probably see stocks go back down and make a new primary bear market trend or bear market low. My call has been that what I was looking for was a bottom in October. So let's pull up, let's say the Dow, and we'll go to a daily chart. We don't really need these moving averages at all. Let's just clean that up. And in September, that indicator I just showed you, the FRA OIS spread, and into October, it was showing financial stress. the Fed made a little minor dovish tweak to some of its language. That was enough to get the peak inflation, peak Fed hawkishness narrative in play. The Dow rallied 20%, CNBC, oh, hey, we're in a new bull market, 20% off the lows. I shot that down. But what I've been looking for was the market to go from a primary bear market downtrend where we're making primary lower highs and lower lows to a intermediate lateral trend. And that's best seen in small caps. Here's the primary downtrend. Again, in this area, I think it was right as we first made this high over here in August. My call was, I think we're going to move to an intermediate lateral trend, which we can see in small caps has happened. You can see this range here, right? That's the lateral trend I've been looking for. That was my phase one plan that will get that rally. Right now, the mega caps are probably the last stage of that rally. And phase two is recession. So I think at that point, we will see a new primary bear market downtrend. So I think that's really covering the gist of what I'm looking for as we go into next week in the Fed. It's going to be really important what the SEP says, what the language of the policy statement says, what Powell says in the press conference at 2:30 on Wednesday, 2:30 p.m. Eastern time. And what the market's going to be looking for is either no rate hike, which effectively is the end of the Fed's rate hike cycle. And they're going to be looking for any, even if the Fed doesn't pause QT, the balance sheet runoff, if they mention it as a potential tool that they can use, the market is going to like that. So I think we can get one more rally. I think the banks, again, very speculative, but I think they can get a huge relief rally. But I would absolutely still stick with what's acting really good, which is the mega caps, the tech sector, the NASDAQ 100. I think these have the potential to lead this last leg up. But after that, I don't think there's going to be much more. So I'm going to leave it off there. I am going to really encourage you to go back and look at last weekend's video. Again, in the description below the video, all these little time markers that you can just click on it. It'll take you right to that point of the video. And usually those sections are 2-5 minutes long. You can catch all this stuff that I was talking about last week that has materialized this week. And I think there's a lot of concepts there that are useful. It's really good to know where you are. So if it's kind of like being on a map, right? A map is useless if you don't know you are here. So that's what we're trying to determine. You are here, and then which directions the market can go into. So I would really encourage you to watch that video or just go through the few areas that are of interest that are linked for you. And as usual, if you have any questions or comments, feel free to leave those in the comment section. If you're a subscriber, even if you're not a subscriber, you can reach out to me at the support email. That's also in the description of this video. If you're a subscriber, of course, you can reach out to me anytime. I haven't had a lot of time this week to work on the new website, but that will be up. That's almost done. So if you're a current subscriber, you're grandfathered in at the current rate, and that hasn't changed since 2008, but it will go up for anybody that comes in after the new website goes live. So you do have a chance to beat inflation and subscribe now. That will be it. Everybody enjoy what's left of your Sunday night. I think it's going to probably be a little bit of a volatile week, Monday, Tuesday, but watch those banks and how they act. If they act really crappy, the Fed may just say, you know what? We are ending the Fed rate hike cycle. We should get a relief rally from that. But after that, stage two is where I think we're moving. Recession, new primary bear market lows. Have a great weekend, everybody. Thank you for watching.